Good evening. I'm very happy to be here to give a speech on the sovereign debt and banking crisis. And we have a whole history of banking crisis, as you can remember. And I'm not going to talk about subprime crisis starting from the US, but I will speak about Japanese experience and compare that with the current European crisis. So I will first give you the overview of how the debt situations look like, and then give you some Japanese experience. And maybe you heard about lost 2 decades of the Japanese economy, which is underperformance of the Japanese economy in the last 20 years, and that has relationship to Japanese banking crisis in the 1990s. And update to the current situation. Then I will give some views about European sovereign debt crisis and banking crisis, which probably some of you are much more familiar with than myself. Okay, so that's the outline. Okay, so this is the government liability, government debt in ratio to GDP, and this is taken from IMF statistics, and this is gross debt. So how much the general government, including central government and local government, owe to the public in the form of government bonds and borrowing and so on. And Japan is by far the highest or the worst in this case. And Greece, then U.S. is sort of in the middle. And I put some European countries which are said to have sovereign debt problems: Greece, Italy, Iceland, Spain, Portugal, and Ireland. So Greece is, of course, the worst among those, and quickly going up. Italy used to be the the worst among G7. That was the situation, but it's holding on relatively steady and projected to be stable. U.S. is catching up very quickly, and Ireland is increasing rapidly, and Portugal is in the same league. Spain is actually much lower in gross debt, and although it's rising, it's still relatively better than other countries. Now, this is gross debt, which is that what they owe, but also government has some assets, right? So if the government sells some assets, the government can sort of cancel out some of the debts, at least theoretically. So let's take some financial assets the government has and deduct from gross debt, which is a notion of net debt. Okay, so this is gross debt minus the government financial assets. Okay, sometimes government has large pension funds. Sometimes they have some public financial institutions which have a lot of assets, or some telecom shares that they are in the process of privatizing. Those are the financial assets they hold. Okay, so in terms of net debt, again, the Greece is worse. I suppose they don't have much assets. Japan is now not the worst, but the second to Greece in this group of countries. Italy, Portugal, not good. US actually becomes lower, and Spain is still lower. And Ireland is probably is getting better soon. Sorry, Iceland is getting better soon. Okay, so this is net debt. Still, Japan looks very worrisome, and that is much worse than, for example, Spain, Italy, and those countries. Now, so those are accumulated deficits of the past, right? So what is the current situation of the every year's budget deficit? So this is the so-called primary balance of the budget situations, which is the expenditure minus, the tax revenue minus expenditure, and net of new issues of bonds and interest payment. Okay, so this is primary balance of budget. Okay, so in this thing, Ireland looks very bad in 2010 because they injected the capital into banking system. So this is the sort of the big dip is that the rescuing banks, private sector banks. So it's shouldering private debt into the public sector, and that is sort of one-time big rescue operation of banks. So this is very unusual, but the sort of necessary operation to save the banking system. And Japan is bad, US is bad, it's like a minus 10% in 2010. And all other countries also had a dip. This is the subprime related crisis, Lehman Brothers shock. And all the countries are supposed to get better from here on. Okay, so the question is that looking at Japan and Italy, how could Europe learn from the past Japanese mistakes, and how Japan could learn from the current European crisis, and give some views on how they will play out in the near future. Okay, so let's start from Japan. All right. So Japan's problem is this very low growth. It's like an average of 1% in the last 20 years. Before that, Japan was hailed as a high growth, rapid growth countries for many decades. But starting from 1992, the problems of Japan started and couldn't grow, right? So, and last 15 years, it's in the deflationary state, which is prices are dropping. Okay, you may think the prices are dropping, that's good. Things are getting cheaper. But that will cause also the production decline and employment decline, and finally the wages are starting to decline. So my salary was cut by 5% this year because of the budget situation is getting worse, right? So the beginning of this low growth was something called bubble burst. That Japan had a real estate boom and stock price boom in the second half 1980s, long time ago, which was just like U.S. real estate boom from 2004 to 2007, and it happened just 15 years earlier, and stock prices, land prices almost tripled, quadrupled from 1984 to 1989. Then prices start to drop in 1990. reason is that Japanese residents, hold 95% of the Japanese long-term bonds. Okay? So it's all domestically absorbed. Again, in contrast to Greece, I think they had 60% held by foreigners. So Japanese residents are content with having only 1% or less interest and still hold on to Japanese bonds. So they are quite risk averse in terms of currency risk, and they trust Japanese government. They will do something in the future to avert a crisis. The current account has been in surplus until the last 6 months, which they turned into negative. So as a country, it doesn't have to borrow from foreign countries, but lending to foreign countries. So that's quite different from Greece. Greece had a huge current account deficit. And there is room to increase taxes. Actually, Japanese government has very low tax to GDP ratio, government expenditure to GDP ratio. It's almost the bottom in the OECD ranking in those sides of the government. Okay, so the value-added tax, which is called consumption tax in Japan, is only 5%. Okay, in Germany, how much? 16, 17? Okay, 19. Greece, it was 19, but after the crisis, they raised to 21%, and then 23%. I'm sure it goes to 25% soon. Sweden, 25%. And so European welfare states has somewhere between 20 to 25% as a norm. Okay? So what if Japan raised consumption tax or VAT from 5% to Swedish level 25%? Okay? Then Japan can actually goes from minus 10% to 0. Okay? So Japan can do it. Raise consumption tax to European level, and fiscal consolidation can be done. Right? So it's only the political will which prevents Japan to solve the deficit problem. Okay? So residents hold 90% of it. Who are those residents? Most of them are financial institutions. So Japanese residents deposit into banks. Then banks, instead of extending loans to big businesses, they buy government bonds. So indirectly, yes, we consumers hold those government bonds, but as direct holders of the bonds are banks. Okay? So what happens if and when crisis happens and the rates start to go up? Banks will have losses on the paper, on the balance sheet. And depending on the maturities of those bonds that banks hold, some banks will have huge losses. Some banks may escape those losses. And we know who holds long maturity and who holds short maturity bonds. So if and when the Japanese fiscal crisis gets worse, like Greece, the banks will fail. Okay? And when banks are failing, you want to inject capital, public money into banks. But since you are in fiscal crisis, you cannot inject capital. That's Greece's problem, right? And may happen and also may happen in Spain. Ireland, it's different. Ireland, it's the reverse. The banking crisis happened, and you inject money, so that it became the fiscal crisis. Okay? So causality is different in the islands. But point is that two are related, the government fiscal crisis and banking crisis, because banks hold government debts, and government will rescue big banks because you cannot fail them of the systemic crisis. So too big to fail problem there. And something strange happened in the last 2 years, something called safe haven effect. So thanks to European sovereign debt crisis, investors flee from Europe to safe countries. Where are safe countries? Switzerland, of course, right? So went to Switzerland and also Japan. Okay, so they disregarded those huge debt to GDP ratio, but just look at the huge liquidity. The debt market is very liquid because Japanese residents trade those government bonds very frequently. So the market is deep, liquid, and they regarded Japanese JGB safe assets. So European crisis, and money went to Switzerland and Japanese bond, and also actually German bond, but the exchange rate doesn't change between Greece and Germany. So, but the bond rate yield went down. Okay, so safe haven effect took Japanese yen to appreciate, Japanese JGB rate to go lower, and so were Swiss franc. But dollar also depreciated. Emerging market currencies depreciated. So it was actually a hell for Japanese corporations, Japanese exporters. That's why Sony, Sharp, and Panasonic are such a trouble in right now. Okay, so safe haven could be hell. All right, so quick updates of what's happening right now. And the recent government statistics, we have only the 3 quarters of last year. But the growth started to be relatively high in the first quarter because that's still part of the reconstruction from the tsunami devastation. And we thought it would continue, but somehow it fizzled out. And the third quarter became negative. And some of this negative comes from the export decline. And this is partly due to the safe haven yen appreciation. Okay. So that's the the update of Japanese situation. I skip this exchange rate part and go to Europe. Okay. So most of you are Europeans. We non-Europeans looking at the Europe, basically Americans, Japanese, and Asians. We thought, why it takes so long to resolve this European sovereign debt crisis? It happened in Greece. Greece is a small country. It's only 3% in GDP of the EU. So if you just throw some money at Greece to guarantee Greek bonds or buy Greek bonds, it can solved. Could have been solved in 6 months. Of course, German government opposed to any bailout. Why? Because it will So it'll be a reward for not having fiscal discipline. It violated EU treaty. Why can you reward those violators? That's one argument. Second argument is that, well, Greece needs all those structural reforms. And crisis is the best window of opportunity to have those reforms. Okay, so that's kind of IMF attitude. Crisis is the best window of imposing reforms. So Germany was playing the IMF role within Europe. IMF later comes in to this troika structure. But so for better or worse, that this crisis was used to impose the structural reform for the weak discipline, weak governance countries. Okay? So it takes time to implement reforms, and you put pressure as long as possible so that those countries can introduce reforms, okay? Having the solutions. Okay. So Japanese success and failure depends on this new government economic policy in the next 6 to 12 months. The government changed at the end of last year, and new government is putting a lot of effort to put pressure on the Bank of Japan to be more bold in monetary easing, and there will be a fiscal stimulus, short-term fiscal stimulus to be applied, but in the medium term, it's going to be consolidation. So short-term fiscal stimulus, but medium-term fiscal consolidation. Very tricky road, but they're trying to do that. Then growth policy will be applied to raise the potential growth rate. And if all those things get implemented and successfully, then I think that finally the Japanese deflationary cycle could be broken, and it remains to be seen. But this year is very crucial for Japan. Okay. Thank you very much.
Thank you very much so far. I think we have some time for questions. Can we start here?
Yes. Professor Ito, I have a double question concerning GDP growth and the absorption of debt on one side, and what do you think is the reason that Japan the growth mechanisms in Japan changed so quickly? If you take a look at the time 1970s to 80s versus 1995 and beyond.
Mm-hmm. Okay, so part of the answer is natural process of something called conversion. So the growing economies, growing emerging economies like China right now is like Japan in 50s and 60s. So it's easy to have 10% economic growth if you are good, but still middle income. Then you can catch up with the advanced countries very quickly. So that is called convergence. So that's a high growth. Then medium growth, like 75 to 89, average of 4 to 5%, was more frontier of the technology, and Japan succeeded it. And I would predict China will be moderate growth, but still catching up the frontier in the next 10 to 20 years. Then 90s and 2000s, which we now call lost decade, I think it's an underachievement by 1 or 2 percentage points. And so it should have been growing at 2%, 2.5%. Actually, it was only 1%. Why? Because I would say, again, the bubble and burst, and bursting bubble was mismanaged, and the banking crisis happened, and series of, again, the small problems in the fiscal and so on. Fiscal stimulus was applied in wrong infrastructure, and so the multiplier effect was low. So it's multiple reasons for the lost decade. But yes, clearly 90s and 2000s is underachievement.
Do you think that economic liberalization can help Japan or Southern Europe to come out of the current crisis?
Yes, of course, I'm all for the structural reforms and liberalization and privatization. Japan's problem areas are agriculture, medical, and health and medical, and energy sector. And I hesitate to name those problem areas in Greece and Italy and Spain, but probably you know much better than myself on those problem areas. But it's always good to have more market-based mechanism with income transfer rather than price controls and so on. So those are the common problems among Japan and Southern European countries. Yes.
On one of the slides, you mentioned the home buyers in the
Mm-hmm.
context of 95%.
Mm-hmm.
Did you see any negative consequences for the economy for Japan, or what do you think of the home buyers? What is so bad about it?
I cannot find it, but maybe this is a good sure. Yes, home buyers. Well, it's in the I think 90s, 80s and 90s. Some Japanese corporations went abroad, and with the FDI and so on. But they had huge losses. One, yen appreciated, so the asset got depreciated in terms of the yen, and probably some of them didn't have the some succeeded, some failed, and so they and also banks, they had a huge foreign operations which were all withdrawn after the banking crisis at headquarters, and so they became really timid in terms of going abroad in the 2000s, and that was one part of the home bias.
Was it just a currency problem? Because I read somewhere. So, do you think it's negative if the banks just invest in their own country, not in another, like
Mm-hmm.
then German banks invest in France is not a currency problem, but do you think it's bad for the economy if you just invest in your own?
Yeah, there's a long literature on why there exists a home bias. And that's not only Japan's problem, but the US also and other countries. And currency risk is one of them. So naturally, that part is not applied to Eurozone financial institutions. And obviously, less home bias among those European banks. And one more thing is that Japanese banks hold equities of the corporations, and equity prices have been dropping in the last 20 years. So they're shedding the equities as prices are dropping, which is not very wise strategy. But so they're shy away from those stocks and buy government bonds. They shy away from foreign currency denominated bonds and loans, and coming back to the yen denomination. So double risk averseness.
Any question?
Can you speak louder?
Yeah, and looking at the severity of Japan's debt situation and their ability to repay their debts, one thing that you didn't mention was the sort of demographic challenge or crisis that Japan is undergoing.
Mm-hmm.
And do you not think that will substantially impact their ability to repay their debts and their financial situation? I think right now, I
Yes, I see that as additional challenge for the fiscal consolidation. And that will limit the way the taxes can be applied. So it's obviously wrong to put the income tax as the main source of fiscal consolidation, because the income tax applied to working age population, they are shrinking and shrinking. So it doesn't get the tax revenues as much as possible. So the entire population have to pay taxes, which is value-added tax. So again, those retired people have to pay, because who accumulated those debts? Those are the retired people, right? So they are responsible, and they have to contribute by way of consumption tax. Personally, I would add tax on pets, because nowadays the people have dogs and cats instead of babies, and they should be taxed.
Any more questions?
So do you expect inflation rates in Japan to significantly increase, also to reduce that huge amount of debt?
Yes, so when the price level goes up, the real burden of the government debts go down, right? So the inflation, like 200% a year for just 1 year, and go back to a 2% inflation rate. So price level goes huge jump, but stay, right? Instead of like that. It's very difficult to engineer that. So I think the moderate inflation, like 2%, 3%, is maximum that you can do. And that's what being proposed, the 2% inflation targeting. So it's, again, interest payment goes up, but so consolidation has to be done very quickly. Well, I think Japan has to do several things at the same time. That is monetary stimulus to end deflation, and fiscal stimulus in the short run, but the consolidation in the medium run, and the medium run growth strategies, which include the liberalization and structural reform. And all put together as a package, only that way the Japan can get out of this deflationary cycle. And tax increases, is that a worry? Well, I think the consumption tax, the VAT, is the least distortionary tax, which is the least impact on economic growth in the medium term. And everybody has to get used to it. Consumers, investors, domestic and foreign. Mm-hmm.
Real estate sector, and that's a bit similar to the misallocation of capital in Spain, for example.
Mm-hmm.
And we've been discussing regulation a lot today, and this comes to the macroprudential regulation of actually preventing asset bubbles, and that's something Europe is discussing at the moment. Did you undertake any measures in Japan in this sector regulation to do this recently?
Right. There are two ways to think about those financial regulations to avoid, to prevent the bubble. And if failing the prevention, the management of the crisis. So the prevention part, it's now become a consensus that regulations on the loan-to-value ratio and diversification among the sectors and the overall risk stress test and those risk assessment is important. So how in the macro, from the macro view, how the banking sector as a whole is exposed to a particular sector is as important as particular individual bank is exposed to those real estate sector. If those measures fail to prevent a bubble and burst, then you need to have the resolution mechanism that you need you cannot be afraid of resolving the failing a bank when the problem is still small. And taking over nationalization or arranging the mergers with some financial gift, those mechanisms has to be there. It cannot be ad hoc application like in 1997 in Japan, 95 to 97 in Japan, or 2008 in the United States, very ad hoc measure. So those resolution mechanism is not in place, but being discussed in Basel. And I think living will is one particular proposal that the banks have to be prepared how the resolution can be staged and so on. So yes, the Japanese experiences and US experiences, now the European experiences all put together. I think Basel will come up with the better regulations.
Thank you very much, Professor Ito.
Okay.
Sharing your thoughts with us.
Thank you very much. Thank you.